From the end, Kyril Courboin.
Well done.
From JP Morgan, runs JP Morgan France. Peter Fenton, who is managing partner or just partner at Benchmark?
We're all just partners.
Both. Okay, all partners. It's everybody's, none of these. And then Philippe Botteri from Accel Partners, our good friends of this event, who threw a great party the other night. If you weren't there, you missed something. Bernard Liautaud, managing partner at Balderton, which used to have an association with Benchmark, but we'll let the historians worry about that. And lastly, Jacques Bughin, to be our moderator, who runs the Global Institute, McKinsey Global Institute up in Brussels. So have at it, guys. Thank you.
Thank you, everyone. Jacques Bughin, McKinsey. I'm a senior partner at McKinsey, as well as running the McKinsey Global Institute. You can pick from my accent that I should be French. I'm not. I'm Belgian. This being said, it's really about the money today. So happy to have you, at least a happy few, to know about the money flowing in this panel. It's all about risk and opportunities. What I will try to do is just give a bit of an introduction, and each of you will have 2 or 3 minutes to introduce, and then we go for some questions. Yesterday, if you got lucky enough to be at the 9:30 session, McKinsey was presenting a bit of the picture about digital Europe, and the statement was that there is, at best, between 2 to 2.5 trillion of value, of GDP value, by 2025. That GDP, if you look at the winners and losers, you can imagine these numbers could be 3 times up and 3 times down, depending on who is losing and who is winning on this thing. So it's a lot of money. Now, maybe there is a lot of money. 2025 is still a long time to go. And if we look back 10 to 15 years ago, the hope was, as well, a lot of money going to be made through digitalization. It didn't happen the way that we thought it would happen. Maybe this time it will be different, and it is already different. If we look at unicorn, decacorns, and the like, these guys are possibly having great private valuation, but they don't use the funding the way possibly we have thought they will be using it, and most of them are not going to IPO. So something is changing, and this is the background, and the background is obviously you guys. What can you say about the risk and opportunities? I will go this way or this way. You guys pick the way you want to go. But be polite. You know, the first one to want to talk will talk.
All right, well, I'll start. I think we've been talking a lot about unicorns and these kind of things, which are billion-dollar valuations. To me, I think the real opportunity in Europe is to start thinking about building billion-dollar revenue companies. And the increase of value depends a lot on markets and sometimes hype. But I think what we need to think about is how do we build really long-term, sustainable, big businesses in Europe. And I think we can do it. But until we build this, then we'll continue to have the biggest companies in Europe being old companies. And we won't create the ecosystem that has been so successful in the US, where you regenerate bigger and bigger companies, which become acquirers, which in itself spin off other companies, and so on and so forth. For that, I think, again, we need to have a mental shift. We need, as venture capitalists, also to be part of that mental shift and to see a bit more longer term. And also, I think we need to have a lot more funding. I think when you look at the differences between Europe and US in terms of funding, in Europe, about same size economy, we invest a quarter of venture of the US. So we're doing an enormous amount of progress in Europe, and that's been a great opportunity. We see now all the different parts of the financial chain. We have seed, we have Series A venture firms, and we have growth capital, but it's still at a level which is, I think, is a quarter of where we need to be. So I think we can celebrate the fact that it's 20% more than last year, but I think we're going to need to move to 50 to more % growth of venture investment in order to be at the right level.
Philippe. So maybe let me start just in one sentence, tell who Accel Partner is. So we're a global venture firm headquartered in Silicon Valley with offices as well in London and India, and we have been fortunate to partner with companies like Facebook in the US, Flipkart in India, or Supercell in Europe. For those of you who don't know Supercell, it's the maker of Clash of Clans. So if you're playing the game, please keep doing and make sure your kids are spending money on it. So to answer the question, I think for me there are two very different things. There is the venture cycle, and we know the venture capital industry is a cyclical industry, and the way it works is very simple. When there isn't much money on the market, the valuations are low, so the returns tend to be higher. These high returns attract more money, the valuations are higher, and therefore returns are going down. And so this is a cycle that has been going on since venture capital was invented in the early 80s. But what gets me very excited at this point today is that despite the cycle, and it's true that we've seen an inflation in valuation in the past couple of years, and especially on the late stage side, we are seeing these valuations going down, and raising $100 million in the next couple of years is going to be harder than it has been in the past couple of years. But there are some very strong secular trends in technology, which I think are going to continue for the next decade and foster innovation. So let me give you an example. The first one that I see is a generational shift. So if you look at the young population today, they live on their mobile phone. So if you take the example of Eric, a young student in France, so he has a date tonight that he wants to do at home. He's going to use Deliveroo on his mobile to order the dinner. For the weekend, he's going to see his parents who lives in Nantes. He's going to use BlaBlaCar for that. On Monday, he wants to find a job as a shift worker in a restaurant. He's going to use an application like Job Today, where on his mobile he can very quickly find a job in just a few clicks. And if he's sick and wants to book an appointment, he's going to use Doctolib to book and find a doctor and book the appointment. So that generational shift, I think, is really going to create a lot of opportunities for new services. And on top of that, you have the connectivity is getting is global and is getting much bigger. So if you look at the number, it's 3 billion of internet users, a number which is growing 9% or 10% year over year. You have 2.5 billion smartphones in the world, and now the cost of a smartphone has gone down as low as $150, and that number is still growing at 25% year over year. And that creates opportunity, because that means that now every market is a truly global market. And so to answer the question of why were there that many unicorns, it's because valuation is a reflection of what happens in the future. And what happens is a company today, they have access to much larger market through these channels. And that's what makes their valuation much bigger. And then the third trend, and I'm going to end with this, is what's happening with cloud computing and API, which today if you want to build a product, you can use different blocks. So you can use, if you need a search engine, you can use Algolia and just use their API, and in a couple of hours you have a search engine. So with cloud, the cost of building a great product and a great technology has gone down in price, and the time to do it is also much shorter.
Thank you. So I'm from the Silicon Valley and a little jet lag. You guys will have to put up with my foggy comments. But Benchmark's an early stage venture firm, similar to my two peers to the right. We're the largest investors in Uber, Snapchat. I serve on the board of Twitter, and so we're sort of at this eye of the storm, if you will, I think, of what's going on right now in the unicorn dynamic. And in our partner meetings, what we talk about in terms of the risks, the single biggest risk right now is the asset bubble of late stage private. And when there's cheap capital, it eventually finds a home. And I think what we see right now is a almost Bernie Madoff-like dynamic where capital comes in, it gets marked up without any public scrutiny, unaudited financials. That then creates a positive feedback loop to the investors, the limited partners who give money to people like us. And that flywheel's been going for 5 or 6 years. So you have 140 companies, 150 companies that have valuations that I think wouldn't sustain in the public market. And the question from our standpoint is that fundamentally good or bad? And what I think is really interesting, if you think about value creation, in any decade, there are really 3 to 5 companies that sustain $50 billion market caps or greater. And we're in a game of hits where one Facebook is what mattered for the prior decade. Maybe it's Uber, Snapchat, Airbnb this decade. But you end up having this sort of super returns for a few and near catastrophic losses for many. And right now, we've concentrated so much money in the late-stage private that those catastrophic losses are happening, but they're not visible to the public. And I think we're going to unwind our ecosystem in a healthy cycle of renewal probably over the next 5 to 6 years. But it occupies our thinking because you have a company like Uber that's fighting a global war against easy capital. And Lyft can raise money, Didi can raise money, obviously in legitimate reasons that Didi in China may have a very durable franchise. But we're possessed with this sense of easy money is making returns and viable company building really challenged. The opportunities, and I'm struck by the fact I walk the floor here, just how many interesting dynamic startups there are in Europe right now. It feels like it's an order of magnitude more than I've seen even like 5 or 6 years ago when I first came here with some frequency. And I thought, why is that happening? And I think one of the great things you spoke to, Philippe, is that the cloud, the idea that all of the technology that used to be centralized in a few communities geographically is now available as a set of APIs, blows open the doors for some of the innovations that's going to be omnipresent to occur anywhere, decentralized. The number one application right now in the United States is a product built in China, in Shanghai, called Musical.ly. And we would have never thought that a Shanghai-based company has created an application that's the number one hit with teenage girls in the United States. And their second application's live streaming video, again, all built on cloud APIs. They use the Amazon Web Services. And so this interesting proliferation of innovation that I think is a great opportunity is partly why I'm here, which is I don't think that Silicon Valley is going to completely monopolize the next 3 to 5, $10 billion companies or $100 billion companies. I think won't be 100% Silicon Valley, which they have been in the past. So I think that's a great opportunity.
So I am the banker, as you can guess, with my tie. And for us, this is obviously a big challenge because on one end, we are financing and helping these guys that are disrupting the world. And on one end, we are competing with these people. We are financing these people as well. And on the second thing, what we're trying to do is to see how we can team up with all these companies because we are obviously, as a bank, serving clients in many jurisdictions and in many different products. And we have also to basically adjust to this disruption in the world. And that's maybe the first thing that I will comment on because we are becoming, being a large bank, we are becoming a technology firm. Remember then JP Morgan merged with Chase Manhattan Bank. The first thing we did was to outsource the IT of JP Morgan to IBM. That was the largest outsourcing contract at the time. When we merged 6 years later with Bank One, the first decision of Jamie Dimon was to terminate that contract and to decide to basically internalize our technology. Today, as a bank, we use 42,000 IT people. We have 18,000 developers, more than a Microsoft. We spent $9 billion in technology investments. And what you want us to do as a client of a bank is to protect the data and the service we're providing to you. To store the information we have, which is massive, 30,000 databases, we have to use, for instance, the cloud, developing private clouds, but also using the public clouds and working with the Amazon and the Microsoft of this world to do that. So that's probably the first challenge we have, which is to store that information and to protect that information. People do not realize that cyber criminality, and you have discussed that earlier on a panel, is a major challenge for a bank. We're spending $600 million per annum to protect our data. We have about every year 250 major viruses. We have 60,000 phishing attempts per month in a company like JP Morgan. When we talk about protecting, for instance, credit card databases, we're talking about 80 million customers. Encryption is certainly something we need to do, but that's a major challenge for us. The second thing we need to do is to recruit the right people to do that. And today, the millennials, they don't join a bank like JP Morgan to spend 40 years, to spend their entire career. They want to be here for 5 years maximum to move probably to the private equity space, to the VCs, to do something different. So we need to adapt to that thing, which is also a major challenge for us. The last thing, and that's obviously what you are all expecting from us when you are a VC, is that we have not only to provide permanent capital, which is certainly something which is needed in Europe, because most of the funding is coming from the US, but we are also here to provide liquidity. And we'll probably discuss that later, is we can see that it's relatively easy to raise money, but it's certainly more difficult today to exit and to monetize your investment, certainly in the IPO market.
Let's continue on risk. And session before was cybersecurity. I don't know what they've said, but I'm quite sure that there is a lot of threats about cybersecurity. There was discussion about AI. AI is always scary in one way, but as we heard from the Google folks, is that there are many ways possibly to pull the plug. Now, what about the financing risk? Bubble, but also, are you taking your own medicine? i.e., are you going to be disrupted by digital yourself? FinTech is one example. And on the VC side, what I find very interesting in your numbers is that if we look today at the data, we come to a conclusion that for one VC investment, pretty much if you're very successful, you're going to have what? 1% that possibly will become a unicorn. Now, if you make an analogy with media, in media, we need 7,000 scripts to get one hit. So it's still not the same stuff, but maybe somebody will take artificial intelligence and will come out to say, I've got the 2%, the 3% hit, and you're going to be disrupted. So, to my question, are you going to take the medicine, yourself, digitization into your own business process? Is this a risk or not? Who wants to take that one?
We have to transform ourselves. And the only way to do it, when you're a large organization like us with 250,000 people, you are certainly a little bit of a bureaucracy. Just realize that we are a highly regulated industry. We have 10,000 people in compliance, basically trying to look at the way you have to deal with data, with protection, with KYC. So now what we need to do is, on many of our issues, is to team up with agile people. So we go and look at small investments, small startups, to develop solutions for JP Morgan. And that's, by the way, the reason why we're here today at VivaTech. It's to meet. We had a challenge that we organized where we interviewed 400, via the net, 400 startups. We have selected 16, and now we have awarded a prize to one company that's going to work for JP Morgan. This is a company called FinexCap. That is a great company in receivable financing. We're going to get them in our incubator in New York for 6 months. They will have access to all the technology people of JP Morgan. And in my opinion, this potentially can be the next unicorn of France.
Just on our end, I think we've started that journey already. You're absolutely right. I mean, there are now a lot of technologies that we should apply to our business ourselves. So we have employed data scientists within Balderton to try to figure out how can we source better, how can we identify among all the thousands of companies out there the ones who have the best chances to succeed. And we try to analyze a number of signals. Now, have we found the perfect formula? I wouldn't say we have. I think it's complicated because at the end of the day, this is very much a people business. And we have a lot of data about the metrics of companies and so on, but we don't have yet all the data about the human elements of all these founders and businesses. And that's where we should have in order to analyze the business. So at this stage, I would say it's still very much a people business, but we're working every day to figure out new ways to make this business more efficient.
Yeah, I'd amplify that, and that our industry is trying to experimenting with different models. Some firms have grown to be more like a corporation. They have lots of services. I think maybe Balderton and Benchmark are similar, that we're sort of artisans. And the belief system we have is that we can't predict the future. And a lot of people come to a panel like this, what's going to happen next? So let's talk about VR and machine learning and driverless cars and drones, and it's mostly bullshit. So and I say that only because like our job is less to predict the future, but to recognize the present most clearly. And the phenomenon that I see today that I think is not well enough understood is a product and experience like Snapchat is undergoing such profound growth in the United States that it's changing a generation's modality of communication. You have 2/3 of the people in the US, and this is eventually going to happen in Europe, of 18 to 24-year-olds that are using the product 20 plus times a day. And if you recognize that present, you start to obsess on, okay, well, what does that mean for payments? What does that mean for the digestion of video content? Video views are on right now, if you're in the 18 to 24-year-old crowd, they're not on broadcast television. So what we try and do is less through algorithms, but through just deep empirical, we're like biologists, study the phenomenon very directly, and then that leads you to see things that maybe others don't see at this point in time. I want to come back to the fintech question, which we wrestle with, which is we love JP Morgan, but we also love Bitcoin. And I had fun debates with Jamie about Bitcoin, but it sure seems like finance as an industry hasn't gone through the kind of upheaval that the telecommunications industry went through. And there's a lot of fees that are being raked on things that you could say, like FX, that aren't fundamental creation of value. And I think telecom had similar, tolls that they were levying. I think JP Morgan may be ahead of it, may actually provoke the changes, but what I think people forget is that how many years on your phone did you have a GPS before you had Uber? 5, 6+ years? Or how many years before broadband actually got to a point where it could allow for a Facebook? And we underestimate, I think, the technologies that are already present and the way that they're going to end up impacting us in the future. And I think blockchain and Bitcoin is just an example. We remain long-term bullish that Bitcoin could be a fundamental store of value, so much so that our fund has an active position in Bitcoin, as crazy as that may sound. And it looked really stupid about 2 years ago. It looks a little less stupid today. And I'm wondering right now, it's just like what's in our presence at the moment that will end up having this compounding positive effect, and then we'll unlock these business models. And I think Bitcoin still has a shot, pretty much more than anything I can think of in the financial services industry, to be massively disruptive. And it hasn't been killed in spite of all the different things that have attacked it. And it hovers at a relatively stable value of $600 or $700 really as a competitor to gold right now, but it could be eventually a competitor to a lot of your core businesses, which I think is exciting.
Yeah, I mean, so to answer your question, so yes, we look at Apani and Mattermark and LinkedIn and all these tools to try and see if we can see some signals, but the reality is that this is not going to get you early in the best company. So let me give you the example of Supercell, for example. So when we invested in Supercell, we invested a $10 million check in a company that was pre-product. So basically, we bet on the team. It was all on the people. And then they launched a few products which didn't work, and then suddenly they launched Clash of Clans. And when they launched Clash of Clans, in 4 or 5 months, it was over. And then there was a follow-on round, but that follow-on round was at a valuation which was very close to $1 billion. So if you're just relying on your tools to find the great investments, you're going to invest in the best company at a very high price. I mean, if you look at the curve at the time it takes for a great product to achieve 1 million users, I mean, you see that time is really shrinking. Like it went, from 5 years, it can be a year now. And so by the time the data is going to tell you it's a great investment, what, everyone is going to know it. And therefore, that's not how you're going to make the big returns.
Fair point. Still on the risk side, and then we're going to move to the opportunity one, which is the most exciting part of the speech, obviously. On the risk side, I'm just amazed by the fact that so many startups, and obviously the law economics one day going to have to apply, which is that excess supply of people trying the same thing one day can create disillusion or markets that cannot be sustained because entry barriers are. The fact that we are all excited about what's happening, as you said about access being pervasive, it's that entry barriers goes down. We know in markets when entry barriers goes down and sunk cost goes down, one day the market either does not exist or does not return anything, or somebody going to displace somebody else. So if you look at your own portfolio, and maybe as well, Kyril, on your fintech element or whatever you're having in the portfolio, in the corporate portfolio, is there any risk that keep you awake at night, especially linked to the economics of the way this evolution of small medium enterprise and new companies are building up?
Well, I'll call it one thing, which is that in any bubble, there
I'm not saying it is a bubble.
No, I'm just saying in any bubble, in any perversion of an economic system, there are givers of capital and there's takers of capital. And we've had 5 or 6 years of record levels of giving, and from the limited partners to the venture firms to the startups, and the gap that's been widening between the money that's been given versus the money that's been returned in liquidity is record levels. And I don't think anyone appreciates what that means, because at some point in time, the limited partners, the people who've been giving the money, reach to get it back, and it's not there. And so the single biggest indicator for us is that the capital being burned in the market, so this is usually on head count, mostly people, not hard assets, is breaking all the prior records of 99, 2000. So the question is the residual some competitive advantage, some durable company that's going to sustain? And I think JP Morgan had this paper, which is a profound thing to read if anyone's interested in investing. The Agony and the Ecstasy is the title of the article. It was one of your economists. And it speaks to the fact that in any market, and especially true in our world, roughly 15% of the companies every year experience a catastrophic loss of value, which is to say they lose 70% of their equity value and it doesn't recover. And that's happening in the private market, just like the public market, but it's invisible. And so we have a portfolio. How do we think about it? We think there's a real discipline for a company to get into the public markets, to earn their keep, to actually have the cadence of audited financials, the quarterly metrics, and you'll be all short-term focused. I don't believe that for a second. Apple built all its market cap in the public market, and they did not have a control position on the board. So broadly speaking, I think our biggest concern is that we delay the maturation of our companies into the public market, and they don't have the disciplines that are required to do Act 2 and Act 3, and we end up with a lost generation of companies as a result of that.
So maybe I'll add to what you said, which I think very relevant. I mean, one of the things that we're really paying attention to at this point is how do we manage the trade-off for late-stage company between expansion and profitability? Because what I mentioned earlier, I mean, with 2.3 billion internet users and 2.5 billion smartphone users, the market is nearly infinite. So if you're a later stage company that you're growing very well, you have raised $150 million to expand, then what are you doing? You're going to open more cities, you're going to open more countries, but this is a road that leads you to raise the next $300 million, right? And a couple of years ago, you could do that, and then you could even raise billions of dollars, right? You look at Airbnb and Uber, which have raised massive amount of money. But now the way I see the next couple of years, I mean, these $100, $200, $300 million rounds are going to be very, very difficult to get, right? So if the companies don't adjust their strategy to say, well, now I've raised $150 million, let's make sure that with that money, I can get to a point where I can control my destiny, meaning when I'm cash flow positive or cash flow break even, I mean, that's where you risk to get in trouble. So for me, I think this is the number one focus, is looking at all our late-stage companies in the portfolio and make sure that they can survive with the cash that they have in their bank. And therefore, that means some trade-off in terms of expansion. But the good thing is that the competitive intensity is also reduced, so you don't have to go as fast in the new country. So you're not losing anything. It just means that things are going to go a bit slower.
I just add one thing along the same lines. To me, what is striking is, on one hand, we're saying today it's much easier to build a company and to build a product because of all the technology that exists, the open source, the access to the cloud, and so on and so forth. But at the same time, companies spend a lot more money than before. Just as an example, when I built Business Objects in 1990, we raised $5 million total of venture, and then we went public. A similar business intelligence company today, and Peter knows about that one, in order to get to where we were about the same time, already raised $600 million. And so it's striking to see that with the amount of cheap capital, a number of companies become, I think, wasteful of money. And so I think we can go back, and it's very important to go back to the fundamentals of where do you spend your money efficiently? And this race to go from 0 to $1 billion in 3 to 4 years, I think has engender sort of some degree bad behaviors. We're now finding, I think, make a lot of money lost on the market. So hopefully, I think as we go through the deflation of the bubble, I think we'll start focusing more on how to spend the money fundamentally in a much more efficient manner within our startups.
But since the beginning of the year, we have seen a change. And it's not raising money. To give you an example, a couple of weeks ago, we raised $3.5 billion with one single investor for Uber on a valuation of 60 billion plus. So it shows that you can get the money you want now. Meaning that Peter can exit a little bit? No way for the time being. These guys, that's a condition. They want Peter to stay in the company as an investor. Now, what has changed is last year we had about 70 IPOs in the US in the tech sector. Since the beginning of the year, 4 IPOs that have raised less than $1 billion. At the same time, we have raised via 100 equity private placement, $19 billion of equity. So it shows you the discrepancy between raising money and providing liquidity.
Yeah. Opportunities. And it's time to go to that. We still have 15 minutes to go. Very first one, let's go to Europe. Europe is obviously starting to catch up slowly. I don't know what it's surely. What will you do? And, Peter, I know that you live in France and you haven't invested too much in France. Philippe is French and you are French and we have Belgium there. So what is the recipe? What can we do for Europe to really becoming, the next 10 unicorns? There will be, at least one will be a decacorn and will be the next Google. What is it that we're missing?
The thing I always speak to is the background, it's the culture. What's the value system of the people in the city, the region, the country? And absent an iconic narrative of a different path, people fall back into what they know. And I think the single biggest catalyst for a region taking off is a hero, a narrative. And in the Silicon Valley, it was Terman. And what Terman did with semiconductors, which then got the flywheel going with Hewlett and Packard, and the whole ecosystem flourished off of that. It wasn't predetermined that this, relatively cultureless, orchard area would turn into this epicenter, but the people made it. And I look at this country and I take someone like Bernard or Xavier Niel, who are carrying the responsibility of unlocking the talent. I invested in a lot of French startups like Docker, but they all moved to Silicon Valley. And so we love backing French entrepreneurs because they're highly disciplined. They're not afraid to be cruel when they need to be. And there's a certain resilience and intensity that I think, is inconsistent with people's images of France. All that being said, we've made no investments in this specific country, not because we decided not to, but because we would have loved to invest in BlaBlaCar, but it's the very few, and the other issue is that most of them have been very domestic oriented. So, okay, Parrot's maybe pushing out, but and BlaBlaCar for sure is Criteo is an example of one that has. Whereas I contrast that to maybe the Amsterdam area, we've seen more that have been global from the start because their markets are so small. Israel's the same thing, but it's going to change. And I think that ultimately the ecosystem, the culture will change when there's a new narrative, a new story, a hero's journey, for lack of a better term, and that becomes what people aspire to go to if they go to École Polytechnique versus a more safe job with a more safe, pedigreed background.
Well, so let me start with two facts, which I think are very revealing about what's happening in Europe. So we opened our office in London in 2000, so that's a bit more than 15 years ago. And if we look at the way we deployed our first funds, all the capital was invested in startups which were in the UK and Israel. If you look at our most recent fund, we invested in more than 12 different geographies across Europe. So that shows you the way the ecosystem has evolved, which evolved from 2 hubs, London and Tel Aviv. And today we have more than 12 hubs. So you have London, but you have Paris, you have Berlin, you have the Nordics, you have Moscow, still Tel Aviv, and also Barcelona and Madrid. So you can really see this tide growing in Europe, and the level of opportunities that we are seeing right now is unprecedented and rising. Now, the second fact that I'm going to give you, which is also very interesting, and that's a bit of a cocorico for France, but if we look at the split between countries in our most recent fund, France is tied with the UK as number 1. So France went from 0 15 years ago in our first fund to being the co-leader with the UK in our most recent fund. And then we have seen the rise of great companies like Criteo, Showroom Privé, BlaBlaCar. So I'm very bullish about what we are seeing in the ecosystem.
So I am an ex-entrepreneur and operator, so I'm always very interested in the way companies scale and build themselves up over a long period of time. And what Silicon Valley has done beyond just being a hotbed of innovation is I think they have refined over the past 20, 30 years the art of company building. And you have a set of recipes that the Americans have developed which are that you find in a lot of really successful companies. And there's been a lot of writing about it. Everybody just to reinforce how you build companies, and all the books and all the things come always from this place. I think what Europe has to do, and that's an opportunity for them, is to develop their own way of scaling businesses. Europe is very different. It will never be Silicon Valley because it's a federation of hubs. So we have Paris, you have London, you have Berlin, you have Helsinki, Stockholm, and so on. But we all, and because of the fragmented nature of Europe, we cannot rely on a very big initial market like the US has. So we have to think differently, and we have to operate more globally from the beginning. And I think one opportunity for the European companies is to, again, refine what is a good model to scale your business up. And one of the things that we can do very well and differently is organize ourselves in a much more global way. Already you start to see a model that is constantly happening, which is the management move to the US and then the R&D stays in Europe. But we can do better than this because that model is great, but at the end, part of the issue, as you said, the management move to the US, and therefore the reinvestment of future wealth will happen probably more there than here. And we need to build our own reinvestment into our own ecosystem. But I think, again, positioning and helping companies to develop themselves more globally, being able to have many more remote offices, I think may be the key to the European future of building a company.
Well, one thing I'd add to that, which is maybe a narrative I tell myself to justify being in Paris, but the industry is going up in its relevance in consumer life. And so when that happens, design becomes a far more important part of the nature of innovation. And Paris is an epicenter of design. It's a place where you can actually get people who think in interactive, what are the experiences you're trying to create? And the substrate isn't clothing, but it's a mobile application. And even in Silicon Valley, what's happened is sort of most people don't know this, but the bulk of the innovation's gone north from the Rust Belt, where all the semiconductor companies were, where Cisco is. They're probably here, so don't make fun of them. But up to San Francisco, that's where Airbnb is. That's where Dropbox is. That's where Square is. That's where Uber is. And the urbanization of our industry, I think, is going to play very well to the iconic cities of the world. The biggest issue that you have in a London, for example, or in New York is that there's competitive industries that suck up all the talent. And Berlin maybe is the most interesting city in Europe from an entrepreneurship standpoint because there's not another industry there. And so you're filled with young people. There's an urban sensibility, a design sensibility. And it seems highly likely that if you look back, the next 10 years there's going to be 3 to 5 $100 billion companies, that one of them comes out of either Berlin or Paris. I'd bet my career on that. It's also highly likely that 3 of them are going to be in the Silicon Valley. And then the rest are in China.
The problem is probably that most of the time the solution is in the US, because the US market is a simple market, is a single market, it's a large market, it's still 40% of the global economy. When you are a French company, by the way, most of the companies that have been successful in the past, like Business Object or Criteo, they IPO'd in the US. After you go and find a permanent capital in the US, you have also to globalize your business. To be global, you have to be in the US. I think also what's interesting, that's the reason why they need so much money, is that they go so fast to become global. A company like JP Morgan, to be present in 80 countries, took 1 century to do that. Uber did it in 10 years. They are in 80 countries. BlaBlaCar is a great model, but for the time being, they're only in 20 countries. And the biggest challenge is to go in the US. And to do that, that's a major investment, and they will need to find the money to fund that development. So that's what we need to do, is to help these guys to become global, to do it fast. It's also interesting to see how faster it goes. For a company like Walmart, it took probably, I think, 35 years, 40 years to generate 100 billion of revenues. I think Apple took 20 years, Amazon 15 years. I don't know if Uber will need to take an additional 5 years to get there. But that's going to be interesting to see how fast you can become global and so big.
But if you look at what is really changing the picture, so why are we seeing billion and multi-billion-dollar company out of Europe? I mean, the main issue in the past was the size of the local market and the time it took to go from one market to the next. And by the time you get there, there's already 10 startups doing it, so it's very difficult. But today, what you have is like through mobile and cloud, everything is global. So if you were a software company and you start in Paris, you can have customers in the US and in India right from the start. And they don't even know that the company is a French company. I mean, it was very interesting for Algolia, which is a search as a service company. Some of the customers thought it was a US company because the website was in English and they have customer support. And when customer calling, it's like, oh, okay, you're based in France. I didn't know that. So that's really changing the picture.
It's easy to scale if you're in the service business. If you're in the B2B, it's slightly more difficult. Here is maybe an opportunity in the sense that if you look at the US is barely 10 to 12% of the economy is manufacturing based. It's 20% in Germany. What about that space? B2B, industrial internet, Internet of Things. Do you see something interesting to be made there in the B2B? It's a different scaling model, but possibly a deep pocket of money to be made.
I think we continue to finance a lot of B2B companies. I mean, software companies in the enterprise space continue to grow extremely rapidly and usually are really good candidates for long, sustainable models. The ones who succeed, I think, are quite often candidates for IPOs. So we're certainly very bullish on B2B and what we can bring there as an operation help to these kind of businesses.
I think there's our industry tends to work better with information flows than physical flows. So when you get into hardware products, things that have physics attached to them that actually have to work, we struggle. And it's sort of this sort of counterintuitive thing that the venture industry is backing relatively low tech, high pace of innovation. And so the other fact is that B2B may be interesting, but 2/3 of the value created in the venture business, maybe more, has come from consumer. So we in some ways we do it just to keep our head above water, but I think the next $100 billion company is likely to be consumer facing versus business facing, and so that we give it some time and attention. But I think it doesn't seem to me that Europe's uniquely advantaged to build those kinds of companies, but I could be wrong.
Well, so what I would say, I mean, probably 60 or 70% of our investments recently have been on the B2B side. So what I think is very interesting on the B2B is the addition of AI and machine learning. So what is a B2B company? It's basically making a process digital to make it more efficient. And now what we're seeing is that with the addition of artificial intelligence and machine learning, you can do actually a lot more. And through APIs, you can actually have this application connecting to each other and communicating between each other, which means that you can achieve a lot more. So I do believe that this will create a great, great set of opportunities for the next few years.
We only have 40 seconds left. So just one question, just out of your mind, you're going to tell me what sector I should be caring about in the future. It's all about high-tech, biotech. It has been the ad tech. It has been the sport tech. What's the next X tech? Is it food tech? Is it, what is it for you?
I would I would repeat what Peter was saying before. It's very hard for us to be predictors of the future. We look at a ton of things, but we look essentially at the founders to tell us what it is going to be. I would tell you just in a few seconds what I look at right now. I mean, a lot of different things on the SaaS side and the mobile side, but one of the areas that I find fascinating right now is everything related to drones. So I'm going to spend a lot of time on this.
Yeah, I think the most interesting thing going on that's going to actually impact our lives is the collision of information technology with the gene sequencing work coming out of Illumina. So you have a $30 billion company that sort of feels like the Intel, and they're sequencing our genes down to now less than $4,000, going to $400, and the volume of information that creates to do everything from cancer treatments that are specifically targeted at the DNA of a tumor to over time, the work that's going around CRISPRs to do some gene modification, which has all these interesting ethical implications. And so it seems like in 10 to 15 years we're going to look back and say, that was the beginning of a long, discontinuous growth curve, much like the internet. And then, of course, there's Bitcoin, which will still have its day.
We obviously, as a bank, only focus on fintech, but it's clear that what's going on in the healthcare sector is fascinating. It is all about data mining, so it's really applying that to the sector that are useful for the communities.
So on my side, what I'm spending a lot of time on right now is around data, AI, and machine learning, and the intersection of all of them. And in the past 5 years, the number of data in the world has increased by 9x. So we're sitting on more and more data. And to Peter's point, I mean, today everyone will wear a Fitbit or an Apple Watch, which collects a ton of data. But the question is, what are you doing with this data? Well, actually, not much today. But I think with machine learning, predictive analytics, and AI, you will be able to extract a lot of value out of that.
Thank you. The session was about building the future. I learned that we cannot build it that way, but at least we can shape it. And I have a few tips to take home, especially about Europe, Paris as well as Tel Aviv. And thank you for your time. Thanks. Bye.